All right, welcome to Compound Interesting. I am Brendan Kelly, and I am a financial advisor. I broke away from the big banks to start my own firm with an obsessive focus on improving client outcomes using active risk management, enriching client knowledge, and understanding client expectations. The name of our firm is Fort Myers Wealth Management Group. We got three core beliefs here. First, preparation over prediction. We'll explain more later. Volatility over risk, and strategies over products. Also believe in clients understanding the role that their advisor has in their financial lives. We'll be using this program to bring truth to light about your financial relationships. What you do with that truth is up to you. I do hope to empower you to make decisions based on your own information. I am, of course, biased to my own firm, and it is my intention to increase my practice through the use of this show. To put it very bluntly, this means I might want your business. We may be a good fit to work together, and I welcome the opportunity to discuss the specifics with you directly. That is my conflict of interest. I might want to work with you. Email any questions you have about that or any other questions that have come up so far in your mind to bk@fmwmg.com. The first segment this week will be the foundational education, aka it's not your fault. You have to take trigonometry to graduate high school, but you never have to learn the difference between a stock and a bond. It's not your fault if you feel like you really never understood any of this. No one has tried to teach you. So, what exactly is a stock? Very simply, it's a share of ownership in a company. Let's take a lemonade stand. Neighbor kid comes to your door and says, I need $100 to start up my lemonade stand. Inflation. I already have 90 from 9 other people. Would you like to invest $10 for the last share in my lemonade stand? You say, okay. First things first, the risk. The lemonade stand doesn't do too well in the Minnesota winters, and the stand is out of business in 6 hours. You're out your $10, and you're never going to get it back. Ignore all the ambulance chaser lawyer letters coming to you through the mail. It's gone. You made an equity investment, that is stock, and it's gone. Instead, let's set the stand up here in sunny Southwest Florida. Stand is chugging along. How do you, the investor, wish to be rewarded or repaid for your investment? A share of the cash flow generated from each passing car? Well, that's dividends. Eventually sell your shares to your neighbor after the stand has doubled its profits? Well, that's a growth stock. You want a lifelong, ever-evolving strategy designed to thread the needle between growth and income? You got to give me a call or email me at bk@fmwmg.com. No products, only strategies. Strategies over products. So yeah, that is what a stock is, share of ownership in a company. Well, Brendan, I don't love the feeling of the risk associated with that investment. What else you got? What exactly is a bond? A bond is a loan to an entity, a person, a government, a corporation, for a stated period of time with a declared interest rate. That's it. It's a loan. They pay you your interest, and they eventually pay you back. Let's take the lemonade stand back into view. Neighbor kid, stand is up and running. You didn't want to get in for the equity ownership. You didn't want to buy stock. However, he is ready to open a second stand around the corner, and he needs a little more cash to do so. He comes to you with a request for a $20 loan for 5 years, and he will pay you a 5% interest rate on that loan. You agree to it? You now have a bond. Every 6 months, he pays you the equivalent of 5% interest or $1 each year split into 6-month payments. So he'll pay you 50 cents every 6 months. Loans to companies are also known as corporate bonds. Corporate bonds typically pay on a 6-month cycle. At the end of that 5-year period, assuming things have gone well, he'll repay you the 20. The risk, the stand goes belly up in 3 years. You have different rights than the original investors, the stock owners, to maybe get some of your money back. If there is anything left to sell, sugar, stirring spoons, chairs, signs, you might get some of your $20 back. But in the event that the lemonade stand goes completely out of business, there won't be much left for you. Lastly, part of the foundational education segment, what the heck are all these different funds? My 401k has a handful. Everybody I know usually has some kind of fund. What is a fund? A fund is a collection of investments. There are 3 common funds. The first, index funds. It's a way to effectively own the whole market. Which market you choose, that's a whole separate episode coming soon. These are, however, very popular currently because of their passive nature and relatively low costs. Generally speaking, your investment here will just do whatever the market does. Mutual funds, typically speaking, have a higher cost. They are actively managed, which means you have a group of investors at the helm trying to make investment selections for you. These are currently falling out of favor in some people's minds because of their higher cost and their inability to perform better than index funds. Most likely, this is what you will see in your 401k at your job. Anything that says target date, that's a mutual fund. Last is an exchange-traded fund. These are usually some combination of one of the first 2. They are a little different in that you can buy and sell them a little easier and a little quicker. The other 2 typically price at the end of a day, whereas you can get in or out of an exchange-traded fund in normal market conditions whenever you want. That is the foundational part of the education that you never received unless you really, really tried. Trigonometry, yes. Stocks, bonds, nope. If you're just tuning in, my name is Brendan Kelly, and I am a financial advisor. I started my own firm, Fort Myers Wealth Management Group, and this is Compound Interesting, where I unleash the brutal truth about the investment industry and answer specific questions about your investments. Next section, we're going to call it sausage making. Nobody wants to see how it's made. I'm going to peel back the curtain a little for you. Remember, my conflict of interest is that I do hope to earn the opportunity to sit with you and discuss the potential for us to work together, as long as either of us is on this planet. I want this part of the discussion every week to empower you to take back control of the choices of the people you work with. Someone who is managing your money, your advisor. What do they do for you? How do they do it? What are you paying them? Are you sure that's all? These are the types of things that we'll cover. If you say, Brendan, that can't be true, Google it. Everything here is Googleable. And then call me at 239-689-9364 or email me, bk@fmwmg.com, to schedule your appointment. So, without further ado, why your advisor isn't paid to care about your results or whether you stay or go. Let's pretend the average large firm advisor produces $500,000 per year in fees and commissions. This is the way that you pay your advisor, either fees or commissions. The firms refer to simply as revenue. Let's say that large firm advisor producing $500,000 in fees has approximately 400 clients. Much more on this in future programs. Let's say that advisor is charging 1% on the $50 million asset base that his clients have with him or her. That is how you generate $500,000 in fees and commissions. This is all fairly standard and very Googleable. The very large firm will receive 65% of the money that you pay. The advisor will take home about 35% of your fees and commissions before taxes, and we'll do all this on a pre-tax basis. So your advisor at the very large firm is taking home $175,000 pre-tax income per year, or roughly $14,500 per month. Remember the 14.5 number. Now let's say you walk into the very large firm because of their national presence and their awesome commercials and your assumption that they must be taking fantastic care of clients because they are so large. Or maybe you already have a separate financial relationship there, like banking. Anyway, round numbers. You retire with $1 million to invest, and you're ready to get started. You go to the firm for any of the reasons stated before. Now, let's say that you are ready to put 100% of your money to work, and the advisor has a managed money account ready and waiting. 100% of it goes into the managed account. We will spend an entire hour on these in the very near future. They are going to charge you 1% on your $1 million, which is $10,000 per year. Now, the firm will receive 65% of that. Your advisor, the person sitting across the desk from you, is going to receive 35%. All Googleable, rough averages. So, your advisor is receiving $3,500 per year to manage the most important thing in your life other than your actual life. $3,500 divided by 12, which is months, comes out to $291 per month. They are already receiving $14,500, roughly, if they're generating $500,000 in fees and work at one of the very large firms. They're getting $14,500 per month already. You bring them $290. You are one of 400 clients, paying them $290 per month. You are in a managed account, which usually means the person sitting across the desk from you has nothing to do with the individual investment decisions being made on your behalf. Your advisor isn't necessarily paid to care about your success or whether you stay or go. If you have ever changed firms where you do your business, it may have shocked you that you didn't get a phone call on the way out. This is why. You be the judge about any of this. It's your financial future on the line. If an advisor cares about your results, it's probably a personal choice for them to make, and it is almost certainly non-financial. Things can get cloudier when you realize that some of the products that are typically employed by the average advisor pay an upfront commission. And if you get under the hood of where those commissions go and how much more impactful in the short term it might be to your salesman or advisor, you start to understand why there's so much focus in this industry on who benefits the most from this advice. Okay, that's all a little scary, Brendan. So WTF? I don't know what to do, but I think I'll know what I'm going to do. I'm going to go find an independent advisor who has an entire alphabet of letters behind their name and who graduated top of their class from one of the greatest financial schools in the country. That could work. Be careful. None of that legally prevents someone from being a scumbag, nor does it force anyone to care. Independent advisors do receive a larger portion of the fees and commissions that you pay. This can cut both ways. I am biased to me and my firm. Yup, but we care. There's no empirical, statistical, logistical way to prove it. You have to come, sit, and talk with a human one-to-one and determine if you trust them and if you do, why. The world isn't lost. There are advisors who care. But the ivory towers could use a little trimming. If you're just tuning in, this is Compound Interesting. I am Brendan Kelly, financial advisor with Fort Myers Wealth Management Group. Email your questions to bk@fmwmg.com or call us 239-689-9364 with your specific questions about your investments. Here on Compound Interesting, we aim to bring you the brutal truth about the investment industry and answer your questions about your specific investments or anything you didn't learn in high school or college. Because again, trigonometry, yes. Stocks and bonds? Probably not. So on this part of the show, we are going to cover a question that comes to us from the internet. This is something I see somewhat frequently. It is going to give you a bit of insight into how an advisor sees you when you walk through the door. Not all advisors, but some. So this is a story from a young lady who was recommended to a financial advisor from one of their good friends. Great, she thought. We've been meaning to meet with someone. We have a kid on the way, and my husband isn't putting anything away yet toward retirement. Younger folks, they set up a phone call with a very large firm advisor. They speak for over an hour. She seems to be asking a lot of questions, the advisor that is, and exploring in great detail a lot of their specifics so that they can set up a plan. Now, this client, potential client, lets the advisor know they have $17,000 or so in CDs and savings accounts. This is the main point of what the client was seeking advice on. The advisor starts to go down different roads. This is a be careful scenario. When you walk in to an advisor's office with an expectation or specific questions about an area of your life financially, and you start talking about different areas of your life financially, and then those different areas of your life financially that you are exploring start to result in products being sold, you are looking at a situation you should probably get out of. This person had some questions about retirement planning and what to do with a little bit of the cash that they have saved up. When they get their plan, after much detail and care was taken to establish that plan, the net result is an entire conversation about how they need more life insurance. Now, maybe true. Don't know. Would need more questions. Answered. The problem is that the advisor knew as soon as this client said, we have $17,000 to invest, the advisor knew they're not going to make any money on this. And a lot of advisors in this scenario will seek ancillary products to, quote, make up for the money they're used to making. So it devolves quickly from there. They ended up also somehow talking about disability insurance, ended up with a plan that was going to be around a $600 to $800 net outlay for a bunch of insurance products, and no discussion on what to do with their $17,000 in stocks, bonds, and CDs. No discussion for options on what to do with the $17,000 that they had saved. This is somewhat typical. If you walk into an advisor's office, due to a lot of the structures of the corporations that they work for, they might not be able to say, hey, listen, I just don't think we're going to be a great fit to work together. Typically, I serve clients who have different needs, and I think you should go elsewhere. They might have to, or might feel the need to, sell you something. So I would like to leave you or present you with the way to empower yourself. Ask the hard questions. It's your money. You should ask. Ask, how much are you, the advisor, going to be paid on this? How much is the total commission? How much am I paying of that? How much does your firm receive in order for you to present this to me? If you walked into a doctor's office with flu symptoms and they immediately recommended amputating your right leg, would you ask why? You should. You should take the same control over your own finances. You must understand not everyone has your best interest at heart. And there is no designation There is no company. There is no way to tell other than sitting with someone, asking the difficult questions, and determining if this is someone that you want to work with for the next 10, 20, 30, 40 years. If you prefer to bounce around advisor to advisor, buying products, then this show probably isn't for you, and thanks for joining us so far. But if you want to establish lifelong relationships with your financial advisor, you have to ask the tough questions. You have to. You deserve to know it's your money. You wouldn't let somebody cut off your arm if you had the flu. Again, I'm Brendan Kelly. This is Compound Interesting. My firm is Fort Myers Wealth Management Group. We would love to have questions from you. BK at fmwmg.com. Call us 239-689-9364. Very near future episodes coming up. We will be discussing what is a managed account. What exactly is an annuity? We will get deeper into the different types of funds and how they may or may not work for your situation. So again, a huge part of this show, this program, this life of mine, this mission, and you should seek an advisor who sees this as their mission, not as their job. But a huge part of this is empowering you to ask tough questions about your own money. The only reason they're tough is because you feel like you don't know enough. You know enough to know that if something feels uncomfortable, it's not going to work. It doesn't matter if the math is right. If your emotions around your plan don't feel good when the math turns sour, by that I mean when markets go down, which they do, you stand a greater likelihood of making a bad choice based on your emotions. This is another focus of my firm. This is something we will talk about every week. This is something I have termed math-motional investing. Emotional plus math. All of the common advice tells you to take emotion out of investing. That works for robots, not great for humans. If you have an advisor who understands you're going to feel certain ways about investments and about markets and about numbers on a page and can work with you through that, that is the first step. What you really need is an investment, a portfolio, a plan, a strategy, wherein your investments react differently to different market conditions. Again, this is preparation over prediction. If you walk into an office and someone starts telling you what the market is going to do, leave. Nobody has a clue. But there are things you can do to prepare yourself and your portfolio for whatever it might do. The volatility is how much your accounts might go up and down. That's different than risk. Risk is permanently losing capital. Volatility is ups and downs. Take these, roll them all into a strategy, and anybody who says there's a product out there who can provide this, you might want to reconsider. There is no package. There is no one size fits all. You have to work hand in hand. Designing a financial plan is a misnomer. It is managing a plan that is important. The advisors who architect a plan and then walk away are doing you a disservice. It is extremely important that you do make changes along the way because your life is going to change. You're going to buy a boat. You're going to sell that boat. You're going to buy a new car. Whatever. These are things that will change your plan. Your investment strategies might change. Interest rates will change, markets will change, economies will change. Your plan should change. It should be flexible. Again, core beliefs of my firm: flexibility, preparation over prediction, volatility over risk, strategies over products. Your plans should change. You should be allowed to feel any way about your investment. The person you work with should not say, "Oh, ignore the way you feel, do nothing always." If you were capable of doing nothing, putting your money into the market for 50 years and leaving it and never worrying about the balance, you don't need an advisor. You're a robot, and you're probably not listening to the radio. If someone tells you every single time you have concerns, "Don't worry, no change is necessary," you might want to consider your relationship with them. We had a bonus question, and that was, what is the largest crocodile of all time? Simple answer: Sarcosuchus, a prehistoric crocodile 40 feet long, a true terror of its day. That was probably the most important part of the show, definitely. So if you missed some of it, I'll sum it up a little, and this will be available every single week on our website at fmwmg.com. You can download. Today we covered a little foundational information that you probably would not have received through traditional education. You probably had to learn geometry and calculus 2 and trigonometry, but rarely would you have ever had to explain what a stock or bond was. So the lemonade stand, we discussed what's a stock, what's a bond. We also peeled the curtain back a little bit on advisor compensation and things that you should look for. Anything that concerns you with your relationships, you might have cause for concern. We also took a look at the different types of funds. We will get much more into that later. And also a specific question from some young folks who probably need to go seek a different advisor. Again, in the end, you should be seeking an advisor who considers this their mission and not their job. If you do it right, and if your advisor does it right, you'll spend the next couple decades working together. It's important that you're not working with someone who's punching a clock. Someone who is truly looking out for your best interest over the coming decades. I'm Brendan Kelly from Compound Interesting, and thank you for tuning in.